Warren Buffett is sitting on the largest cash pile in Berkshire Hathaway's entire history, and most retail investors have no idea what that actually means for their money. There's a specific pattern buried inside Berkshire's latest 13F filing that smart institutional money is already reacting to. By the end of this video, you'll know exactly what it is and what it means for your portfolio right now. Let's get into the numbers, because the numbers tell the real story. As of the most recent disclosure, Berkshire Hathaway is holding approximately $189 billion in cash and short-term treasury bills. $189 billion. That is not a rounding error. That is a deliberate, calculated, strategic posture from the most studied investor alive. Here's what makes that number hit differently. At the end of 2022, Berkshire's cash position was roughly $109 billion. That means Buffett has been quietly pulling chips off the table, adding $80 billion in dry powder, while the S&P 500 was running up over 50% from its October 2022 lows. While retail investors were piling back in, chasing the rally, Buffett was doing the opposite, and that contrast deserves your full attention. Now, the portfolio itself still holds some of the most recognizable names in American business. Apple remains the crown jewel, though Buffett has now trimmed that position by more than 50% from its peak weighting. At one point, Apple represented nearly 50% of the entire Berkshire equity portfolio. That concentration alone was a statement. The trim is an even bigger one. So what's left? The top 5 equity positions as of the latest filing are Apple, American Express, Bank of America, Coca-Cola, and Chevron. Classic Buffett, brands with pricing power, durable competitive moats, and consistent free cash flow generation. These aren't glamour plays. They're businesses that compound quietly over decades. But here's the tension. Buffett has been a net seller of equities for 7 consecutive quarters. 7. That's not a one-time portfolio rebalance. That's a sustained directional signal from someone who has navigated every major market cycle since the 1960s. Now, what does that mean for you, sitting at home, managing a $50,000, $500,000 portfolio? Because that's the real question, and I'm going to give you a straight answer in just a moment. First, let's add one more layer. Berkshire's equity-to-cash ratio is now at one of its lowest levels in modern history. When you back out the top 5 holdings and calculate what percentage of total assets is deployed in publicly traded equities versus parked in T-bills yielding around 5.3%, the implication is stark. Buffett is effectively saying, the risk-reward in today's equity market does not meet my threshold. That's the signal most people are glossing over. While retail investors are still rotating into AI momentum plays and celebrating index highs, one of the most disciplined capital allocators on earth is collecting 5.3% risk-free and waiting. He said it himself at the 2024 annual meeting in Omaha in front of 40,000 shareholders that finding attractive acquisition targets at reasonable prices has become extremely difficult. Extremely difficult. Those are his words. Keep them in mind. But here's the part that changes the whole picture, and this is where most analysis gets it completely wrong. Buffett's cash accumulation is not a prediction that markets will crash. Read that again. Buffett has never, not once in his public career, tried to time the market. He said explicitly that he doesn't know what the market will do next week, next month, or next year. Nobody does. What he does know is price versus value. And right now, at current valuations, the price being asked for most businesses doesn't justify the value being offered. The cyclically adjusted price-to-earnings ratio, the Shiller CAPE, is currently sitting above 34. The long-run historical average is approximately 16.8. We are more there, and double the historical mean. That doesn't mean a crash is imminent. It means the margin of safety that Buffett built his entire philosophy around, the one Benjamin Graham drilled into him at Columbia, is razor thin right now. Here's the contrarian reframe. Buffett's cash position isn't fear, it's optionality. It's the ability to deploy $189 billion the moment something breaks, the moment a crisis creates a price disconnect from intrinsic value. He did it in 2008, he did it in 2020, he is positioning to do it again. The question isn't whether he's scared. The question is whether you'll have dry powder when he pulls the trigger. That's the insight retail investors consistently miss. They watch Buffett sell and think, should I sell too? That's the wrong question. The right question is, am I positioned to buy aggressively when the opportunity arrives? Because that is exactly what Berkshire is engineered to do. So here's your actionable intelligence. 3 takeaways you can actually use. Now here's the question I'll leave you with, and I want you to think about this carefully. If Warren Buffett, the greatest value investor who ever lived, with a $900 billion market cap company behind him, with a 60-year track record of outperforming every benchmark, if he can't find enough attractive opportunities to deploy $189 billion, what does that tell you about the real risk embedded in the assets you're currently holding at today's prices? Drop your answer in the comments. Genuinely curious whether you think Buffett is being overly cautious or whether the market is significantly overpriced right now. That debate is worth having. This video is for educational purposes only, not financial advice. Always consult a qualified financial advisor before making any investment decisions. Past performance, including Berkshire Hathaway's, is not indicative of future results. Portfolio intel. Stay sharp.